Okay, so I'm starting to record and we're going to be going over the practice questions for handout number 10. This portion of the recording is shorter because we spent the first part of class doing the chapter 19 in-class group work. And so if you see this only lasts 25 or 30 minutes, you'll know why. Because we're only covering learning objective 1 in chapter 20 today. So we're starting with the practice questions. Which of the following reasons why a company is involved in leasing to other companies? So we want to say, are these benefits to leasing? And so interest revenue is certainly a benefit to them. There is some risk, of course, to that they don't pay, but in general, if you have good credit policies, you hope that interest revenue will be positive. High residual values. So essentially, when you lease something, usually they're structuring it in a way that allows them to have high residual values. So if you think about, bless you, a lease on a car, what do they do on a car to make sure it has a higher residual value? They limit the miles that you can drive it, and then they charge you for additional miles over it. So ideally, it comes in less than what the average person would do for driving in a year. Tax incentives. So ownership has tax incentives, and by keeping the asset on your books, you're allowed to depreciate it. Depreciation is, of course, tax favored, and so that's actually a benefit. Right? Guaranteed bargain purchase options. So that can be included, that is not necessarily included on all of it. And giving a bargain purchase is not necessarily something you would want to do as the lessor anyways. You'd want to have it close and maybe a slight bargain. So our answer here is going to be 1, 2, and 3, or letter D. If a lease transfers control or ownership of the underlying asset to the lessee, then the lease is classified as answers financing. Number 3, which of the following best describes the current practice in accounting for leasing? So leases are not capitalized. That's not true, right? Now we have all long-term leases are capitalized. And now all leases aren't capitalized because on short-term leases, they just expense. Number 4, while only certain leases are currently accounted for as a sale or purchase, the theoretical justification for considering all leases to be sales or purchases. The principal reason that supports this idea is C, a lease reflects the purchase or sale of quantifiable right to use of property. Our answers are D, E. Let me see. Oh. B is right. It's 1, 2, and 3. I did start to highlight C and then walked it back. So I know this is a lot of reading, and I didn't want you to have to write all this out. It's basically straightforward stuff, but I did want to talk about it. So what is a lease? It's a contractual agreement between a lessor and a lessee. This arrangement gives the lessee the right to use specific property, which is owned by the lessor, for a specific period in time. In return for the use of the property, the lessee makes rental payments over the lease term to the lessor. And so we talked, what are some of the benefits of leasing? Now, it says in the book that for most of these, you don't have to put anything down, but all the leases that I've seen lately are not quite 100% financing. There's some sort of fees in the beginning to initiate the lease, but theoretically, those are fees and they're not the asset itself. So if you don't have a deposit, you might be able to finance the 100% of it at a fixed rate. Okay. Protection against obsolescence. So there are all kinds of features that are available when you talk about computers, cars, equipment that change fairly often. And because a lease is usually 2, 3, 4 years, when you're done with that, you don't own it, it goes back to them and you can get something new. So you're not holding on to an asset that's become obsolete. Flexibility, they can tailor it to meet your needs. And this is where they talk about in the book, the tax consequences of it. So if you're a new company and you don't have income in those first couple of years, you don't need the deductions. So by allowing the lessor to keep it on their books and structure it as an operating lease on your end, then you can benefit a little bit from a lower lease payment. All right. So that's one of the reasons. There are other reasons as well. You can shorten the term of it. If you only need this thing for 1 year, you only need to do it for 1 year, whereas ownership typically requires, the same amount of time for payments, but then you own the vehicle at the end. All right. And then less costly financing. I don't know, that's debatable. It's hard because lease financing isn't always transparent. When you go and buy something, they usually tell you this is the interest rate that we're charging you. With leases, you kind of have to impute the rate most of the time. They'll talk about in the book, sometimes you know the rate, sometimes you don't. Lease documents aren't as straightforward always in giving you all the things that you have on a purchase document. What are the lessor's benefits? So profitable interest margins. And again, if they're not pulling all of the risk, then that's an ideal situation. But most of the time on these interest margins, they are holding the risk. So downturns can hurt them, leasing. Stimulating sales of a product. So we probably see cars advertised more than anything. And you'll see a $100,000 vehicle and they'll say $500 a month for payments, $5,000 due at signing. And you say, well, how do they figure out those payments for 2 years? How does that make sense? Because if you were to go to buy the car and let's say finance the whole thing, those payments could be double or triple. And the reality is because that residual value on the back end is high. So the rent that they need to qualify to make money isn't that high, and it can drive higher cost products to your customers to buy higher cost products for lower lease prices than they would for purchases. The tax benefits we talked about, and then providing the high residual value we talked about. Okay. Finance lease. The lease transfers control or ownership of the asset to the lessee. And this can be actually transferring control of it, or it can be effectively transferring control of it. And we'll see some of the tests that we have later to determine whether or not it's a finance lease. There are 5 tests that a lease must pass one of them in order to be recorded as a finance lease. The operating leases, I love how accounting does this fairly often. They say, okay, we're going to define this one, and then the rest is everything else. So if it doesn't qualify as a finance lease, it automatically qualifies as an operating lease. And I think about, going back to manufacturing costs, right? You got direct labor, direct material, and then what's everything else in the factory? It's overhead, right? Indirect and expenses, and it just all gets pumped into overhead. So this is something that's commonly done in accounting as well. It's kind of like investments. When you talk about it, they're like, okay, these are at fair value, these are at historical value, and then if they don't fall into one of those buckets, it's everything else, and that's the available for sale category. If the lease doesn't explicitly state that it qualifies as a finance lease, which sometimes it does, for example, transferring ownership by the end of the lease term, The lease must be examined to determine if it's a finance or operating lease. So we have bargain purchase option. These are just some terms that you should know when we start to analyze this. So a bargain purchase option or termination options basically says, does the lease grant the lessee an option to purchase the underlying asset that is reasonably likely to be exercised? And so what does that mean? Does the purchase option, my English is not so good today. Is the purchase price or purchase option less than the expected fair value? So you'll see examples as you read this chapter. You know, if somebody wants something to buy it, they have the salvage value or residual value where they're thinking, okay, it's $10,000. If you offer it to them for 1,000, you're pretty sure that they're going to buy it. If you're at 9,000, well, maybe that's a discussion, right? Whether or not they would buy it. But if it looks like it's a good deal, then it should be considered. Now, what does that mean for us? Is that we add any bargain purchase to a lease payments to calculate present value. And for bargain renewal option, this is the same thing. You know, is the renewal likely based on a discount versus fair value, right? And you have the same type of thing if bargain renewal add to lease payments and add the years to the term of the lease. So if it says, you know, you can rent it for 4 years at $1,000 a year or $1,000 a month, but then it says in the last year, in the 5th year, you can rent it for $100 a month, you would assume, A, we're going to rent it for that time. And so you would say, what's the term of the lease? 5 years. And you would use the bargain amount to calculate your present value for just that 1 year. And this is where we get to talking about variable payments. So it says in substance fixed. So the payments can vary, but the payments are known by the parties at the date of inception of the lease. So if the lessor is concerned about inflation, they can say, listen, your payments for the first year are going to be $10,000. But in the second year, they're going to be indexed. Now, if they tell you the index, we still don't know what that index is going to be in the future. But if they tell you a specific amount, your payments are going to go up by 2%, then we know and we can calculate it, and we can use those payments to calculate the present value. These are variable lease payments that are uncertain in the future. If the payments adjust to an index or something that happens in the future, they are not known at the date of inception. So the company uses the initial payment for the calculation for the duration of the lease in calculating present value. So e.g., if the payment is $1,000 a month for the first year, but is indexed to the housing market and changes each year, then the amount used to calculate present value would be the number of payments of the 1,000. The additional payment each year in the future would be expensed in that year or that period.
Stop when you said it or something. I don't know what that means. Kind of hesitated.
My brain is a little broken. I have a little ADHD, and by that I mean a lot. And so sometimes I do words and sentences. That's why I have to write all my notes down, so to make sure that I communicate it properly. Yeah. Ah, there you go. Crossing. Yeah. Probably more valuable at this stage of your career, but just need the right singer. So residual value is that what it is that they're guaranteed or not guaranteed at the end of the lease. And so the lessor will set their residual value based on what they think it is, and that will help them calculate the payments. And when you're using this in like Excel to calculate the present value, that residual value goes in as kind of a negative. And so you can see the calculations in the book, why they're able to finance things so cheaply. And there are two types of residual value. There's a guaranteed residual value. And in this case, the lessee has an obligation to guarantee the value of the asset at turnover will have a certain value. Too many values in there. Sorry about that. It's not good English. It's really just guaranteed that asset at turnover will have a certain value. And so when calculating lease liability, the guaranteed residual value is included. Unguaranteed residual value, the lessee does not have any obligation to the lessor at the end of the lease. This one is kind of confusing to me. So if the lessor does not have an alternative use for the asset after being returned, then the lessee classifies the lease as a finance lease. Now, again, I don't understand the logic of that one because you don't care once you're done with it as your organization. But essentially, they're saying they're making this for you and you're going to use up all the useful life, hopefully. What's that? Right. I mean, there's got to be a reason. And I think it's because basically they're saying that the asset is mostly consumed at that time. Nobody would make an asset that they couldn't sell at the end of it or get rid of if they weren't using up most of the life during the lease. And then the discount rate. So use the rate of the lessor if known. If not, use the implied rate that the company would have for similar asset type loans. Sometimes you'll hear that as called the incremental borrowing rate. So we got a couple quick examples we'll go over. And then we'll talk about the lease classification test. So Elliott Events entered into a lease with Premier Party Rentals on January 1, 2025. Premier will lease large party tents to Elliott for 3 years at a rental rate of $2,000 per month. In addition, Elliott can continue the lease term for another 2 years for $200 per month. What is the term of this lease that would be used in the lease test? So you've got the 3, but then the rate drops to $200. And so if you're a company and that equipment is still good, you're going to lease it for the 5 years, right? Because you're getting a bargain renewal option. And so you have to use 5 years for the lease. Now, if you knew 100% that you were not going to exercise it, then you could opt out of that and use 3 years. But in general, when they don't give us that information, we have to assume that they would because it's financially smart. Barry's Bakery leases a packaging conveyor for 5 years. The annual lease payments are $50,000 per year, payable at the beginning of each year. Inflation is expected to trend at 5% per year, so the lease payments will increase by $2,500 each year. What are the lease payments in 26 and 2027? Pretty straightforward, right? So we add 2,500, so bless you. 50,000 in 2025, 52,500 in 2026, and 55, bless you, thousand in 2027. And so the answer is C. Example 3, Metalcraft leases a building from Capital Leasing for 10 years with a monthly lease payment of $15,000. The lease contract allows Metalcraft to terminate the lease after 3 years by paying a cancellation clause of $225,000. At the start of the lease, Capital is reasonably certain that Metalcraft will not continue the lease past 3 years. What are Metalcraft's lease payments that would be used in the present value test? And so we have 10 years. With a monthly payment of $15,000. And so that's actually, I'm sorry, we're doing it monthly, right? So we got 15,000 times 12, and it's only going to be 3 years. So that's 540,000. And then you have to add the termination clause, fees. And so that's 225,000. And so we add those. And that's 765,000. Now keep in mind, in calculating that, we would discount those values back, right? So this would be number period 1 at their implicit rate, whatever it is, and then the 540,000 would be annual annuity due. And so you would calculate that. So this is pretty straightforward. I'll talk about it now and then we'll go over it again in next class because I'm sure after a week off, you're going to kind of forgotten about it. And we won't get through the long example today. So we'll just talk about this. All right, so they have 5 tests. One is transfer of ownership. So does ownership transfer? And so it should be explicit in this case that at the end of the lease, the product is the lessee's. If not, then we go down and we go to the next test. If it does transfer, then it becomes a finance lease. Purchase option test. Is there an option to purchase that is likely to be exercised. So think about options. Not lower than fair value. What's that? So if it does not have a purchase option or bargain purchase option, then it would not pass that test. If it does, then it would be called a finance lease. Lease term. Does a lease term greater than 75% of the useful life of the asset? And that should be is again. If the answer is no, it can still be classified as operating. If the answer is yes, then it becomes a financing. Present value test. Does the present value of all payments are they greater than 90% of the fair value? That should be R. If the answer is no, then it can still be classified as operating. If the answer is yes, then it's a finance. In the alternative use test, does the lessor have a use after the lease? If the answer is yes, then it can be classified as an operating. If the answer is no, then it's a finance lease. And so if those terms are all no, except for the last one, it would be classified as an operating lease. If all are no, or if all are yes, or any one of them are yes, then it's a finance lease. I think they word this one slightly different than what I do, and they call it a no and yes, but you get the idea, hopefully. Okay, so we'll pick up again. We'll talk about the lease classification test on Tuesday after we have that short time for you guys to turn it in. You won't have any more class time on Tuesday, but you'll be able to turn in your assignment for in-group work for chapter 19 if you're doing it on paper. If not, you can just turn it in online.
Can I get another one of these?
Absolutely. Which, is it the handout for this chapter? Okay. There you go. You're welcome. All right, everybody online, thank you. Have a great week. If you have any questions, please email me.